Hello everyone and welcome back to the YouTube channel of BeingACCA. This is Tushita Gupta, ACCA affiliate, and we are continuing with our FM chapter-wise revision. This is the fifth video in this series, which is about chapter number 5. Now, chapter number 5 is about your relevant cash flows. So regarding the NPV, when you're solving NPV questions, what all should you consider? What all should you be ignoring? What is relevant? What is, just given to confuse you or probably is not useful when you're working out your NPV. So what all is relevant, what is not, this is what we are studying over here. So this is a deep dive into, a help, a guide as to what all should you be considering when you're solving your NPV questions. So let's get started. Number one thing that, this chapter starts with is that the assumptions that are there when it comes to the NPV method. So assumptions, rather you can say these are assumptions under NPV. So whenever you are doing a question through the NPV method, the first thing that you are going to assume is that your initial investment goes out in year 0. This is number one assumption. This means that whenever you're calculating your NPV, when you have the years written down, you're going to show the initial investment as a negative figure in your year 0. It's going to be subtracted considering that your initial investment goes out in the very first year itself, which means right now, which means year 0. Then let's talk about another assumption. Second point over here being that your interest cost should not be taken. Should not be taken. Now, why should you not be taking the interest cost? Basically, when I say interest cost, I'm talking about the interest that you pay on the debt that you have taken. So any interest cost will not be deducted, will not be subtracted from your profits over here. Why? Because this is taken care of when you are discounting the cash flows. So when you use the cost of capital or when you use the discount rate to discount the cash flows, this interest cost is automatically built into this. That is why you do not have to separately account for the interest cost. This is the second assumption. Third assumption over here is that any cash flow that is there at the beginning, any cash flow arising at the beginning of the year is assumed to have arisen at the end of the previous year. Now, what this might seem complex to you, but what do we mean by this? So basically, whenever you're working out any NPV calculation, the figure that you put at year 1 and at year 2, basically this figure signifies something, a cash flow which has happened at the end of year 1. So you put it over here. At the end of year 2, so you put it over here. But what if something has happened at the beginning of the second year? So where do you put it? You cannot put it here because this signifies end of year 2. You want it to be posted at the beginning of year 1. So the closest thing that you can do is that you put it at the end of year 1. End of year 1 essentially means the starting of the next year. So this is what the third assumption talks about. Now, there are a few adjustments that you can possibly get in your exam. So what are these adjustments? Number one, you will have to account for the inflation when it comes to your NPV calculation. So how are you going to account for inflation? Number one, there are basically two types. Either examiner is going to give you a general rate. This means a single rate of inflation is applicable to all items. Single rate of inflation is applicable to all of your items. Now, the second assumption, criteria could be a specific rate. So basically what will happen over here, you will have specific rates for different items. So over here you will have multiple rates. Now, what do I mean by this? I'll give you an example of both of the things. Let's suppose my examiner has told me that in my economy, there's an inflation of 5%, which is the general inflation. So I will be applying this 5% of inflation to sales, to variable costs, to fixed costs, to anything that I do with money. I'm going to straight away put 5% inflation on that. But when it comes to the second case where you're talking about specific rates, examiner is going to give you separate rates that, there's going to be 2% inflation on selling prices, then 3% inflation on raw material prices. So this is how the examiner is going to specify the inflation rates which are applicable on different items. So if you have separate rates, you can use those specific rates. Otherwise, the general rate which will be provided can be used for all of the items that you have. This is what inflation element talks about. Now, when it comes to cash flows, and now we're talking about inflation. So with respect to the cash flows that we have, there can be two types of cash flows. Number one is your real cash flows, and number two is your nominal cash flows. Real cash flows and then nominal cash flows. Now, what's the difference between these two cash flows? If you are accounting for inflation, then you are presenting your flows in form of nominal cash flow. So this is with inflation. And if you're removing the aspect of inflation from cash flows, you're just looking at how much something is really worth, then you're looking at it without inflation. So this is the primary difference between your nominal cash flows and your real cash flows. Now there's a Fisher formula which helps you to navigate through these two types of cash flows. This formula, I think, is also given in your formula sheet in the exam. 1 plus I equals 1 plus R into 1 plus H. This is what the formula goes like. Now over here, your I represents the nominal interest rate. R represents the real interest rate and H represents the inflation. So if you see, to add inflation to the real, you get your nominal cash flows. This is exactly what I told you guys just over here. Now let us move to other adjustments that you can possibly get. So you can, probably you will have to adjust your fixed costs and your variable costs. So how can adjustments look like? Number one is going to be, fixed costs. So before we talk, before we speak about fixed and variable costs, let's first study a concept of relevant costs. Now, what costs are important and what costs are not important? So this is, this carries on from your management accounting, and also, it is something which is very well used in your performance management exam. So this is a very important concept. Try to grasp as much as you can. Now, when it comes to relevant costs, there are two types of costs which are always considered to be relevant. Number one being your incremental costs, and number two being your opportunity costs. Now let us understand one by one what do these two terminologies mean. Now when it comes to your incremental cost basically means additional, extra, anything which you're spending over and above what you're doing presently is what is called as an incremental cost. Let's suppose I'm, going towards a new project. Now, because I'm going into this project, I need a new warehouse to store this inventory. As of now, my inventory needs are totally met by my current warehouse. But if only I take up this project, I need to, rent out this additional warehouse because the number of units are going to increase. So because this is something which is additional, which is extra, only because of the project, only then it will be considered as a relevant cost. This is what you mean by an incremental cost. Then opportunity costs are essentially those costs which is, if you have studied the definition goes, it is the cost of the next best alternative foregone. So let's suppose if you have invested your money in such project which is giving you a 20% return, if you had not invested in this project, then you probably would have invested someplace else, which was giving you, let's suppose, a 15% return. So opportunity cost is nothing but, when you're sacrificing one thing to get another thing. Now, obviously, you'll only benefit if you are putting your money into a place which is more beneficial than your next best option. So this is what opportunity cost is about. Then let us talk about irrelevant costs. These are costs which are not relevant. You will not consider them. You will ignore them in your calculations. Number one cost over here is your sunk cost. I'm first writing all of them and then I'll explain them. Sunk cost, committed cost, and then the last one over here being non-cash flow cost. All right. So the sunk cost, basically, like the name suggests, it's sunk. It has already went inside the water. It cannot come out. So this is what a sunk cost is. Whenever you have done any sort of research when you were planning to take up a project or not. So even if you do not take up that project, that money is already spent. It cannot come back. That money is spent whether you take the project or you don't take it. So that is why it is not relevant and hence it will not be considered in your NPV calculations. Secondly, we have committed cost. Committed cost is any cost which you have promised to pay today. Although the cost is going to be in the future, but you have promised to pay that cost today. So basically, today I've made you a promise that after 2 years, I'm going to give you 100 rupees. So this is a committed cost. I have committed to pay you this much money in the future. This is what committed cost stands for. Even if you take a project or you do not take that project, this is something which you have committed, which you will have to fulfill. Hence, this becomes an irrelevant cost. Now, talking about the third cost, which is the non-cash flow cost, basically, like the name suggests, it talks about any cost which does not involve any actual inflow or outflow of money. So, for example, depreciation is a classic example. You are charging depreciation in your books of accounts, but you're not, actually paying out money from your pocket towards depreciation. So, this is what non-cash flow costs mean. Because we are looking at the cash flows in NPV and these are the costs which do not really have any outflow or inflow of cash. This is why this is not relevant in our calculations. These are 5 relevant and irrelevant costs which you should always keep in mind whenever you get stuck in any question that should I take this in my calculation or not. Just come back to these 5 points and see whichever cost in which this fits in, and then you will have your answer. So these are the costs which you will consider if you want to know whether you should take them or not. Now coming back to the fixed costs and variable costs. So when it comes to fixed costs, when is a fixed cost going to be relevant? Number one, it's going to be irrelevant if it is irrelevant, then you all right. So if your fixed cost is irrelevant, then you do not incorporate it. And then if you have any fixed cost which you find relevant, maybe could be because it is incremental. So if it is relevant, then you will also consider to inflate if it is needed, inflate if required, and step up if required. What do we mean by step up? So let's suppose presently I am paying $60,000 as my fixed cost, but because now I'm going to produce additional output, my cost, even though it's fixed, but because it's a step up kind of a cost, that if I go towards 70, an increase in the number of units, it's not going to increase in the exact proportion, but some of it is going to increase. So rather than paying 60,000, now I will be paying 70,000. So I will take the balance of 10,000 which is incremental because of this project, and I will consider this as a relevant cost. Now this is it about your fixed costs. Then another adjustment which the examiner can possibly give you when it comes to your working, the NPV questions is your working capital. Now, always assume, unless it is mentioned otherwise, your initial investment in working capital is going to go out in year 0. Why is this the case? Because you want to manufacture and sell something at the end of a year. So but you need money to actually buy the raw materials to start your production, to pay your labor. So if you want to sell something at the end of the year, right now you have to bring in some money as the working capital to pay your suppliers to buy the raw materials. This is what this assumption is for. If it is not mentioned otherwise in the question, your initial investment in working capital will always go out in year 0. Then the second thing over here is that you will take in the later years only the incremental investment. What do I mean by incremental investment? Let me give you an example. So let's suppose my working capital requirement in year 1 is 100,000. In year 2, I need 170,000. And in year 3, I need, let's suppose, 200,000. So this is what my working capital requirement looks like. So how will I put it in my NPV calculation? Is that in year 0, I'm going to have to pay $100,000 out from my pocket. Now, because this money is needed for year 1, this has to go out in year 0, which is exactly what I told you in the first point. Now, when it comes to producing goods for the second year, money is going to be needed at the end of the first year. So in the second year, I need $170,000, but I already have put in $100,000. So additional, I only need 70,000, which means in the, at the end of the first year, 70,000 more is going to go out from my pocket. So this is what I will put in my NPV calculations and not 170,000. Likewise, for the money that is needed in the third year, I'm going to put it at the end of the second year, which essentially means if 200,000 is my requirement and 170,000 is already there, that means my business only needs 30,000 more. So in second year, at the end of the second year, I'm going to show an outflow of 30,000. This is what I'm going to show in my workings. Entire absolute amounts will not go, only incremental figures will go in your NPV calculations. Number 3 over here being, in case of inflation, if inflation is there, your working capital will also be inflated. All right. And the next point that we have over here is that all invested working capital is going to come back to the business. Hence, it should be shown as an inflow in last year. So if you see, let's suppose my project was for 3 years only, and now, the project has ended. So when the project has ended, the entire money which was there in the last year is going to come back to me. So at the end of the third year, I'm going to have a positive 200,000 coming into my business. Hence, it will be shown as a positive figure. It will be shown as an inflow in the very last year. These are the possible adjustments which can be there with regards to your working capital. Now let us move towards the very last adjustment which can be there, and this pertains to taxation. Now, as far as taxation is concerned, number one thing which you're supposed to remember is that wherever tax is present, you're supposed to use, if tax is present, you're always supposed to use a post-tax discount rate. There may be a scenario where in your question you have two discount rates given to you. One is pre-tax and one is post-tax. So if taxes are levied on your cash flows, make sure that you're using the post-tax, after-tax discount rate in your NPV calculations. And the second thing, as far as taxation is concerned, that you have to remember that in the last year of the asset, so this is regarding the capital allowances that you get on assets, non-current assets. So in the last year, how can you find out your balancing charge or allowance? This is something which is very well taught in your taxation exam, although a lot of students would have probably claimed exemptions for the same. So how do you calculate your balancing charge or allowance? Is that, number one, you first take the value of the asset net of already claimed written down allowance. So you have the book value after depreciation has been claimed, and then you take the asset disposal value. And then you compare both, you find out the difference between the both, and the difference is either going to give you a balancing charge or a balancing allowance. Let's suppose you're making a loss, so the tax authorities are going to give you an allowance, and if you're making any profits, that means according to your books the value is less, but on disposal you're getting a higher value, then you have to pay a balancing charge on your asset. So these are all of the adjustments which can be there in your NPV. This is entire chapter 5. I hope that this video was useful in helping you towards revising for your exam. And I'll catch you in the next video for the next chapter. Thank you.